Imagine two retirees. Let us call them Alice and Bob. They both retire with exactly $1 million. They both invest in the exact same S&P 500 index fund. They both withdraw the exact same amount of money every year to live on. And over the course of their 30-year retirement, the market gives them the exact same average return. On paper, their financial lives should be identical. But here is the reality. Alice dies at age 90, leaving a massive inheritance to her grandkids. Bob goes broke at age 78 and has to move into his daughter's spare bedroom. How is that mathematically possible? The only difference was the specific year they retired. Alice retired into a bull market, and Bob retired into a crash. This is not a story about picking the right stocks. It is a story about the hidden danger of timing. It is called sequence of returns risk, and if you do not have a plan for it, your average return means absolutely nothing. Most of us spend our entire working lives obsessed with one number, which is our average annual return. We look at historical charts and say, well, the market does 8 or 10% on average, so I will be fine. I used to think that way too. But that average is a lie once you start pulling money out. Sequence of returns risk is the danger that the order of your investment returns, combined with your withdrawals, determines whether your money lasts. It turns out that getting your bad years early in retirement is mathematically catastrophic compared to getting them later. Today, I am going to walk you through exactly how this works using a visual stress test I built. We are going to look at two portfolios with identical averages but radically different outcomes. And then, most importantly, we are going to talk about how to bulletproof your plan so you do not end up like Bob. If you enjoy deep dives into the mechanics of wealth that go beyond the surface level headlines, do me a favor and subscribe. It is the best return on investment you will get on your time today. To understand why this risk is so deadly, we first have to unlearn something we have been taught for 40 years. When you are working and saving, also known as the accumulation phase, the order of returns genuinely does not matter. In fact, volatility is your friend. If the market crashes while you are 30 years old and contributing to your 401k, you should be celebrating. You are buying units on sale. You are dollar cost averaging. If the market drops 20%, your automated contribution buys 20% more shares. When the market eventually recovers, you have more shares participating in that growth. The math works in your favor. You can verify this in any spreadsheet. Take a set of returns, scramble them in any order you want, and if you are just contributing and never withdrawing, the ending balance is almost always the same. This creates a false sense of security. We get used to ignoring the drops, thinking they are just paper losses that will bounce back. We train ourselves to just hold on. But the day you retire, the math flips upside down. You enter the decumulation phase. Now, you are not buying shares. You are selling them to pay for groceries and property taxes. This is where sequence risk bares its teeth. If a crash happens now, you are not buying low. You are selling low. You are forced to sell more shares just to generate the same amount of cash. If your portfolio drops 20% and you need $40,000 to live, you have to liquidate a significantly larger chunk of your ownership stake than you planned. Those shares are gone forever. They are not there to help you recover when the market bounces back. This is what financial geeks call reverse dollar cost averaging. It is a spiral. The portfolio value drops, so you sell more shares, which lowers the balance further, which means you have even less capital working for you to catch the recovery. It is a mathematical gravity well that is very hard to escape. The problem isn't just the math, it's what the math does to your head. I have talked to retirees who hit a bear market in their first year. Imagine you have saved $1 million. You hand in your resignation, you get the gold watch. 2 months later, the market tanks, and your balance is down to $800,000. But you still have to withdraw $4,000 for your living expenses. Psychologically, this feels like bleeding out. You aren't just losing paper gains, you are eating your seed corn. This is where panic sets in. The rational part of your brain knows markets recover, but the survival part of your brain sees your life savings evaporating. This is when people make the fatal mistake of going to cash at the bottom. They lock in the loss because they cannot stomach the volatility combined with the withdrawals. And once you go to cash at the bottom, the game is essentially over. You have crystallized the sequence risk into a permanent reduction in your lifestyle. So, the core principle we need to establish before we look at the charts is this formula. Volatility plus withdrawals equals poison. You can handle volatility alone, you can handle withdrawals alone, but when you mix them, you get a toxic reaction. This is why the average return metric is dangerous. An average is a smoothing mechanism. It hides the bumps. But in retirement, you live on the bumps. You do not experience the average, you experience the path. And if the path dips too deep too early, the average return over 30 years becomes irrelevant because you will run out of money before you get there. The protocol for retirement planning, therefore, isn't about maximizing returns anymore. It is about managing the path of those returns. We have to shift our mindset from "how do I get rich" to "how do I ensure I never have to sell a stock when it is down 30%? That is the only game that matters now. You might be thinking, surely this is an edge case. Surely, if I just stick to a safe withdrawal rate, I will be fine even if the market dips. I wish that were true, but the data shows something far scarier. You can do everything right, save the right amount, pick the right low-cost funds, and keep your spending modest, and still fail purely because of bad luck in year one. Let me show you exactly how extreme the difference can be with a real-world simulation. Let's look at a concrete example. I have built a spreadsheet that models two investors, Investor A and Investor B. Both start with $1 million. Both withdraw $40,000 a year, adjusted for inflation, and both invest in a portfolio that mimics the S&P 500 returns from the years 2000 to 2014. The average return over this period is roughly 4 to 5%, depending on dividends. Here is the twist. Investor A gets the actual returns in the order they happened. That means they retire in the year 2000, right into the dot-com crash, followed eventually by the 2008 financial crisis. They get the bad years right up front. Investor B gets the exact same set of annual returns, but I have reversed the order. They get the recovery years of 2014, 2013, and 2012 first, and the crashes of 2008 and 2000 happen at the very end of their retirement. Same returns, same withdrawals, just a different sequence. When we plot Investor A on the chart, it is painful to watch. In year one, the market drops. Their $1 million shrinks. But they still take out their $40,000 plus inflation. Year two, another drop, another withdrawal. By year three, their portfolio is down significantly, maybe to $600,000. Now, even when the market creates a small rally in year 4 or 5, that gain is applying to a base of 600,000, not $1 million. The math is punishing them. The compounding engine is broken. They are gaining 5% on a fraction of their original wealth. As we scroll down the sheet, we see the portfolio struggling to keep its head above water. By the time they hit the 2008 crash later in the sequence, the portfolio is too fragile to withstand it. It enters a death spiral. This is what we call the point of failure. The money is gone. Now look at Investor B. Remember, they have the exact same returns, just reversed. They start their retirement with a few years of solid growth. The market goes up 10–15%. Their million grows to 1.2, then 1.4 million. They are taking out their $40,000 withdrawals, but the growth is outpacing the spending. their base is expanding. By the time they hit the bad years, the negative returns, at the end of the simulation, it doesn't matter. They have a massive cushion. A 20% drop on a $2 million portfolio still leaves them with $1.6 million. They are practically bulletproof. At the end of the same 15-year period where Investor A is nearly broke, Investor B actually has more money than they started with. The difference in ending wealth between these two lines on the chart is hundreds of thousands of dollars. And again, I cannot stress this enough. The average return was identical. This simulation proves that the average return is a meaningless metric for a retiree. Investor A didn't do anything wrong. They didn't buy fancy sports cars. They didn't gamble on crypto. They just had the bad luck of retiring in 2000. Investor B didn't do anything smarter. They just got lucky with their start date. This highlights the inherent unfairness of sequence risk. It is the one variable you cannot control. You cannot choose what the market will do the year you hand in your keys. This is why standard financial advice often fails. Calculators that tell you you have a 90% chance of success are aggregating thousands of scenarios, but you only get to live one life. You only get one sequence. If you pull the short straw, you don't get a do-over. You have to build a plan that assumes you might be Investor A, not Investor B. So, is the solution to just hoard cash and never invest? That is where most people go wrong. They get so scared of the crash that they move everything to a savings account. But inflation will eat that alive. You need growth to beat inflation, but you need safety to beat sequence risk. It feels like a paradox. How do you step on the gas and the brake at the same time? The answer lies in how you structure your first 5 years. Financial planners call the 5 years before and the 5 years after retirement the red zone. This is the decade where your portfolio is at its absolute maximum vulnerability. Think about it. When you are 25, you have very little money, so a 50% market crash doesn't lose you many actual dollars. When you are 85, you have hopefully spent down a chunk of your money, so you have less to lose. But at age 65, you have the highest balance you will ever have. A 20% loss on $1 million is $200,000. That is a massive hit. This is also the moment you stop adding new money. The contributions stop and the withdrawals start. It is a complete reversal of flow. Because the balance is so high, the dollar value of the losses is maximized, right at the moment you lose the ability to replace that capital with income. This 10-year window is where the war is won or lost. We need to look at the math of recovery in this red zone. If your portfolio drops 50%, how much does it need to gain to get back to even? Most people intuitively think 50%, but the math says 100%. If you have $100 and lose 50%, you have $50 left. To get back to 100, you need to double your money. That is a 100% gain. That is hard enough when you are just leaving the money alone. But if you are withdrawing 4% a year while trying to recover, the math becomes nearly impossible. You are asking your portfolio to generate massive, record-breaking returns just to stay flat. This is why digging a hole in the red zone is so dangerous. You aren't just digging a hole, you are digging a hole while someone is shoveling dirt back in on top of you. You have to prevent the deep drawdown in the first place, because the math of recovery implies a time frame you simply do not have. I want to circle back to the emotional side of the red zone, because spreadsheets don't have feelings, but you do. Imagine you retired in late 2007. By 2009, the news is talking about the end of the global financial system. Your portfolio is down 40%. You are watching your life's work evaporate. The pressure to stop the bleeding is immense. This is when people sell, and if you sell in the red zone, you lock in the loss permanently. You convert a temporary market fluctuation into a permanent lifestyle reduction. The stress of this can ruin your retirement even if you don't run out of money. Who wants to spend their first 5 years of freedom glued to CNBC, terrified to buy a coffee because the Dow is down? Managing sequence risk isn't just about the money lasting, it is about your peace of mind lasting. You need a strategy that allows you to ignore the news during those critical first years. So, what defines the point of no return? It is usually a drawdown early in retirement that exceeds 20 to 25% of the total portfolio value, while withdrawals continue. Once you breach that threshold in the first 3 years, the probability of the portfolio surviving 30 years drops off a cliff. It is like an airplane taking off. If the engine fails at 30,000 feet, you have time to glide and figure it out. If the engine fails 10 seconds after takeoff, you are in big trouble. The red zone is the takeoff. We need to design a flight plan that assumes turbulence on the runway. We cannot rely on clear skies. This brings us to the actual solutions. We know the problem, we know the math. How do we actually structure our money to survive a bad sequence? Conventional wisdom says you should be aggressive to get growth, or super conservative to be safe. But the real solution to sequence risk is actually a weird hybrid. It involves holding assets that lose money against inflation on purpose, just to buy you time. It sounds inefficient, and honestly, it hurts to do it when the market is roaring. But this inefficiency is the insurance premium you pay to guarantee survival. The first and most effective defense is something called a bond tent, or a cash buffer. The idea is simple. Do not sell stocks to pay for groceries during a crash. To do that, you need a source of spending money that is not linked to the stock market. You build a tent of safe assets, cash, treasuries, short-term bonds, that peaks right at your retirement date. You might hold 2 to 3 years of living expenses in absolute safety. If the market crashes the year you retire, you do not touch your stocks. You spend from the cash buffer. You give your stocks time to recover. You are effectively buying yourself a 3-year window where the stock market's performance is irrelevant to your daily life. If the market is down in year 1, you spend cash. If it's down in year 2, you spend cash. By year 4, usually, the market has recovered, and you can go back to selling stocks. This strategy works because it breaks the correlation between your spending needs and market volatility. Remember the formula: volatility plus withdrawals equals poison. The cash buffer removes the withdrawals part of that equation during the volatility. You are still withdrawing from your net worth, but you are not withdrawing from the volatile assets. You are consuming your stable assets. This prevents that reverse dollar cost averaging we talked about. You are never forced to sell low. You are essentially becoming your own bank. When the market is bad, you loan yourself money from your cash reserves. When the market is good, you sell some stocks to refill the cash bucket. It turns you into a contrarian investor automatically. You are buying low and selling high simply by managing your cash flow correctly. I have to be honest about the downside. Holding 3 years of expenses in cash or short-term bonds creates a drag on your portfolio. If the market goes up 20%, your cash is sitting there earning 5%. You feel like you are missing out. It feels inefficient. This is called cash drag or opportunity cost. But you have to reframe how you see this money. This cash isn't an investment meant to grow. It is an insurance policy meant to protect the rest of your portfolio. You don't complain that your car insurance premium yields 0% return. You pay it so that if you crash, you don't go bankrupt. The cash buffer is the exact same thing. It is the cost of ensuring that a bad sequence of returns doesn't wipe you out. To implement this, you don't need complicated products. You just need buckets. Bucket 1 is your immediate needs, 12 to 24 months of cash. Bucket 2 is stability, 5 to 7 years of bonds or fixed income. Bucket 3 is growth, stocks. When you need money, you look at bucket 3. A stock's up? Great, sell some stocks. A stock's down? Leave them alone and take money from bucket 1. This simple decision tree can drastically reduce your sequence risk exposure. It puts you in control of the timing, rather than letting the market dictate when you sell. And that control is the difference between investor A and investor B. The second major lever you can pull is flexibility. The standard 4% rule assumes you take out the exact same inflation-adjusted amount every year, regardless of what the market does. That is rigid, and rigidity breaks things. A better approach is dynamic withdrawals. This means you agree to tighten your belt if the market tanks. If the portfolio drops significantly, maybe you forego the inflation adjustment that year. Maybe you cancel the big vacation. Maybe you withdraw 3% instead of 4%. Research from places like MIT and Vanguard shows that being willing to cut your spending by just 10% during a downturn can virtually eliminate the risk of running out of money. It turns a binary failure, I am broke, into a minor lifestyle adjustment. We are eating out less this year. It gives your portfolio room to breathe. Think of your portfolio like a breathing organism. When resources are scarce, it needs to hibernate a little. When resources are plentiful, it can be active. If you treat it like a machine that must dispense cash on a schedule, you will break it. Dynamic spending rules align your consumption with reality. And here is the cool part. Because this lowers your risk so much, it often allows you to start with a higher initial withdrawal rate. If you are willing to cut back in bad times, you can safely spend more in good times. It is a trade-off between certainty and income. If you demand certainty, you have to spend less. If you accept flexibility, you can live a richer life on the same capital. Retirement is not a math problem with one fixed answer. It is a series of trade-offs managed over time. Sequence of returns risk is the single biggest threat to your financial security in that first decade. But it is a manageable threat. It requires you to look past the average return and respect the volatility. It requires a buffer. It requires flexibility. And sometimes it requires the humility to say, I cannot predict the market, so I will build a plan that survives even if I am wrong. If you are 5 or 10 years away from retiring, do not just look at your number. Look at your structure. Run the Investor A test. Ask yourself, if the market crashes 50% the day after I quit, what is my plan? If the answer is, I don't know, you have some work to do. But now at least, you know where to start. I want to hear from you in the comments. Have you stress tested your retirement plan against a bad sequence of returns? Or are you banking on the average? I read every comment because I learn just as much from you guys as you do from me. If this video helped you visualize the risk, hit that like button so the algorithm shows it to more people who need to see it. And if you want to see more deep dives into the mechanics of money, make sure you are subscribed. Thanks for watching, and I will see you in the next one.